While knowing the number of units to be sold in order to break even is very useful, it's also useful to know the break even point in sales dollars. This way, a manager can know what sales number they need to hit in order to break even and perhaps adjust pricing accordingly. So, the break even point in sales dollars makes it easy for a manager to see how close they are to breaking even. If you think about when you go into a restaurant or you go into any type of store and they go to check you out, the store is likely using a point of sales system which collects sales revenue data. So our equation for break-even sales dollars is break-even sales equals the total fixed expenses divided by the contribution margin ratio. Let's look at that formula using our example of the Whittier Lawnmower Company. They sell 1,000 lawnmowers. We know it's $400 each, and the variable expense per unit is $325. The total fixed expenses are $45,000. So we're going to calculate the contribution margin ratio. We're going to see what that is. We're going to calculate the sales revenue that Whittier must make to break even using the break even point in sales equation that we just talked about. And we're going to prepare a contribution margin income statement based on the break even point in sales dollars to make sure that it all checks out. So what is the contribution margin ratio? The contribution margin ratio is the contribution margin per unit. If you remember, that's our selling price minus our variable cost of selling each unit divided by the price we're selling it for. So in this case, we know we're selling each lawnmower for $400. We know the variable cost per unit is $325. That gives us a $75 contribution margin per unit. Divide that by the price, selling price of $400 per unit. 75 divided by 400 is 0.1875 or 18.75%. So we saw that the contribution margin ratio came out to 0.1875. This is telling you don't round that. We want our operating income to come out to zero because we're looking to see how much it's going to take for us to break even. You don't want to round it because that will skew the result. And now we'll plug that contribution margin ratio into our formula to see what the break-even point in sales dollars is. So we have our formula, break-even sales dollars equals the total fixed cost divided by the contribution margin ratio. The total fixed cost is given to us of $45,000. We just figured out that the contribution margin ratio is 0.1875. $45,000 divided by 0.1875 is $240,000. That's the sales number we need to hit in order to break even. So we'll plug those numbers into an income statement just to check our work. We figured out our break-even sales point is $240,000 in sales. Our total variable expenses, that's our contribution margin ratio times our sales, so it's 0.8125 times $240,000. That's $195,000. $240,000 minus $195,000, that's $45,000. That's our total contribution margin. Our total fixed expenses were $45,000. $45,000 minus $45,000, operating income of zero. So it checks out that we need to have $240,000 in sales in order to break even. Okay, let's look at an example again with a service organization. I changed some of the numbers from when we were looking at it from the perspective of a break even in units. So you're an attorney again. This time you're charging $200 an hour for your services. The variable cost per hour is $100. Your fixed cost for running the office is $30,000 a year. We want to figure out how much you have to bill before you break even. So we look at our formula. Break-even sales equals the total fixed expenses divided by the contribution margin ratio. So we need to figure out what the contribution margin ratio is. We're billing $200 an hour. Variable cost per hour is $100. 200 minus 100 is $100 divided by the cost we're billing per hour of $200. 100 divided by 200 is 0.5. That's the contribution margin ratio. We plug that into the formula. We have total fixed expenses, which are given of $30,000. We divide it by the contribution margin ratio we just figured out of 0.5. and that gives us $60,000. So that's our break-even sales number. You must bill $60,000 before you will break even. Let's plug that into an income statement now. So we had sales were $60,000 if we want to break even. Our total variable expense, that's going to be our contribution margin ratio of 0.5 times our total sales of $60,000. That was $30,000. 60,000 minus 30,000 gives us a contribution margin of $30,000. Subtract out our total fixed expenses of $30,000. That gives us operating income of 0. So it checks out. We must bill $60,000 before break even.